Good morning and welcome to this Wednesday, May 3rd, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. And what you need to prepare for in the trading day ahead is the Fed. We got the Fed coming up at 2 o'clock today. Latest policy decision. I think everyone in the market pretty much is expecting 25 basis point hike. Even despite some on Capitol Hill asking the Fed not to raise rates again. I don't think it's going to matter. I think the Fed is likely to continue its rate hiking policy. But the interesting part is going to be what they say at 2 o'clock after they announce the 25 basis point hike. I think the market would really cheer on if they do not hike. But I really doubt that that's going to happen. I expect they'll hike. But what will they say? Because that's what the market's going to use to try to figure out what they're going to be doing down the road. Bond market's already screaming to them to stop. Capitol Hill's screaming to them to stop. But the Fed has a mind of its own, continues hiking rates. I would say while they're certainly showing that they are serious about fighting inflation, I just don't like the fact they keep raising short-term rates given what's going on in the banking area. So we've already seen a couple banks fail. According to Jamie Dimon, that's it. There's no other ones out there that are like the ones that have gone under. However, keep raising rates and you keep making the inverted yield curve even bigger and bigger, and that could have an impact on banks. I'm not saying that's what caused it. I think it was a contributing factor, but I think we've got poor management on both banks' part and on the Federal Reserve part. I would not count them out of having some responsibility in this. Remember, Federal Reserve, we always think about them just raising rates and trying to figure out how to stabilize prices and create jobs, but they oversee our banking system. They're the oversight board, if you will. They're the oversight authority. And so some of this is on them. They go out and they meet, or they go out and they do their audits. They do Fed audits of all these banks, and they're getting reports constantly. They should be on top of things like this. That, to me, these mid-sized banks that fail, I got to wonder how it escapes the Fed's wrath, because I audited banks and I remember being in banks, and banks would look at us as the good guys. I was on the audit team from the CPA because the audits that they got from the Fed were so intense. I just don't know how some of this stuff isn't spotted beforehand. But anyway, that's a whole separate story. We could beat that one to death some other time. But my point is, the Fed does have responsibility for overseeing these banks. That's one of their mandates. So what happened? Where did the ball get dropped? Is it really seriously just poor management? Or did the Fed do a poor job of regulating the banks it's supposed to oversee? I don't know. I guess, again, we could have a long debate on that one. Anyway, it is Fed day, so 2 o'clock, we're going to find out probably that they're raising rates by another 25 basis points, chasing the ghost of inflation. And I say that mostly because that's what the bond market is saying. I'm not saying it just because me personally. I'm watching what the 10-year Treasury yield's doing. I mean, it continues. It's down another 4 basis points this morning. Right now, we got futures. We got the Dow futures up 14, S&P up 4.5, NASDAQ up 18 3/4. So a little bit of relative strength in the NASDAQ this morning. Crude oil prices down another $2, 3%, back down to $69.50 a barrel. And the 10-year Treasury yield down another 4 basis points, below 3.40%. One thing that a bond investor is interested in is making sure that their return is sufficient to cover future inflationary issues. If you're taking on a 10-year Treasury yield right now, or 10-year Treasury bond that yields 3.4%, you're not building in a whole lot of inflation expectations. So clearly the bond market's much more concerned about where we stand economically than it is about inflation. It's been like that for a while, and yet the Fed wants to keep raising rates. And again, are they responsible for some of the problems we're seeing in the banking industry? I don't know. I don't know the answer to that question. It's pretty complicated, but it's at least something that folks should be aware of. Anyhow. All right, let's go ahead and jump into some of this. Let me show you what happened yesterday. So on Tuesday, we had the Dow Jones Industrial Average finish down 367 points. That was a little over 1%. S&P 500 down 48, also over 1%, about 1.15%. We had NASDAQ down 132 points, also down a little over 1%. Mid caps down 35, minus 1.43%. Small caps down 21 points. That was 1.86%. So again, mid caps, small caps taking the brunt. Look at the small caps down, ready to break down again to multi-month lows. Not a good area of the market right now. And I've had folks either say to me or write to me, what's going on with small caps? You know, can the market go higher without small caps? Well, I mean, the market's always better when you've got all areas of the market going up together. No doubt about it. But not everything can lead. The benchmark S&P 500, some groups will lead it and do better than the S&P. Some groups will lag. When I look at the small caps, I'm seeing a group that's been lagging for a while. And in fact, if you go back since this secular bull market started back in 2013, small caps have mostly either lagged or have trended lower or trended even with the S&P 500. It's not, small caps really haven't provided the big lift during this bull market. This is 10 years now. So I don't look for small caps to be leaders, but I also don't want them breaking down to multi-month lows. That's going to take a big part of the universe, to the downside. And if you're wondering why breadth numbers aren't strong, all you got to do is look at small caps and mid caps. Look at the Russell 2000. It's the 2,000 smallest companies of the Russell 3000. So when the Russell 2000 is going down and is below moving averages, while your S&P 500 is above moving averages, when you start looking at how many companies are above or below certain moving averages, if you're looking at the entire market, of course, there aren't going to be as many because you've got a lot of small caps that are struggling. We've been talking about this for a while. How much has the downtrend in the small cap index impacted the uptrend in the NASDAQ? I would say very little. NASDAQ right on the verge, actually the QQQ, NASDAQ 100 just broke out a couple of days ago. While the SML, the S&P 600 small cap index is down near its low over the last 6 months. We have a bifurcated market. And as I said, I would much prefer everything be going up together. But small caps going down or underperforming, that does not have a very strong history of stopping a bull market that's based on the large market cap companies. The NASDAQ, S&P, Dow, these are all market cap weighted indexes. They are heavily influenced by large market cap companies. And I would argue our economy is heavily influenced by large market cap companies. So I don't understand the whole breadth issue, to be honest. I've never really seen, I've done a lot of research in my time. I don't really see that it's that beneficial to follow it. I see just as many bad signals in breadth as I see good signals. And for that reason, that's why you don't hear me talking about breadth on the show. Sorry, I'm not a fan. Looking at the sectors, discretionary, the only group yesterday in the positive, discretionary. Market took a hit. Got a lot of folks, bearish folks, thinking It's the recession. Well, discretionary holding up yesterday. Now, granted, discretionary has not been a great group. I would say even, I mean, we had a strong January. Since then, this has not been a particularly strong group. But with a big down day, don't you think that would be a group that would be heavily sold? And it wasn't. The only group going up, discretionary. Energy taking another pounding. I mean, talk about a chart that's just fallen apart. And this is partly why I don't do a whole lot of trading with energy. I mean, if you've listened to me on the show here over the last several months, I've said, okay, energy looks bullish, and then it falls apart. And then it's like, oh, energy's falling apart, and then it rebounds. I mean, it just kind of lives in its own world. There's a lot of geopolitical concerns. You got to pay attention to the dollar. Certainly crude oil prices themselves have a big influence on energy. And, you know, crude oil prices dropping, that's certainly a significant signal that the global economy isn't what we want it to be, or isn't what the market is forecasting it wants it to be. And so that's creating some problems, without a doubt. But the group itself is really hard to predict. I find energy among all the sectors, I think energy is the hardest one to figure out which way it's going. Just when, again, you think it's going well, it tops. You think it's going down. I mean, who knows? Maybe today, right now it's down to 69.21 per barrel on crude oil prices. Maybe we have a big reversal later today. Maybe something happens with OPEC. Who knows? And we get so many outside influences that drive energy. It makes it very difficult for me. And again, that's why you don't hear me talk about a lot of energy stocks. I find them very volatile and very difficult to have a lot of confidence going into those trades. Anyway, financials down 2.25%. Financials and energy, there's a lot of value stocks in those groups. Same with real estate. 3 of the 4 big ones to the downside were more value oriented. One thing I pointed out to our earnings beats members yesterday is, yes, we were, moving lower. Yes, we're coming up on Fed day. Maybe folks are getting a little bit, taking some profits, moving a little bit to the sideline ahead of the Fed. But I would think that it would be growth. I mean, if I was worried about a Fed meeting and the Fed saying something either about inflation or maybe another rate hike or anything like that, I would want to be getting out of growth. And yet one of the key growth areas was the only group to go up yesterday. Do you see technology among these bottom 4? I mean, communication services pulls back, but it's right at the key resistance established from February. It might just be normal profit taking. I'm looking at the market saying the market is preparing for higher prices. That's what I see in terms of rotation. I've been talking about rotation for almost a year now. It was literally in May of 2023, we hit that low. The next low in June, all rotation started changing in the market. January through the May low of 2022 was very bearish. Everything was going down, and it was going down all day long. It was clearly distribution. Since the June low, I would argue it's been characterized by retail traders panic, lots of gap downs, lots of morning selling, followed by Wall Street accumulation, lots of late morning, afternoon accumulation. That's how Wall Street builds its shares. The market doesn't come out and say, okay, the bottom is in, we're going to start going higher. Everybody jump in, and Wall Street's going to jump in with you. That's never going to happen. The Wall Street firms get in before you and me. They're not telling everybody what they're doing. The only way you see what they're doing is on the charts. That's it, on the charts. Anyway, enough of that. Let's move on. 10-year Treasury yield. So here's the update here, just under 340. So it continues to move lower. The lows that we saw a week ago seems to be challenging those. I don't know, maybe that 327 is going to come back into play again. We could see big moves in all of these different areas with the Fed at 2 o'clock. Sometimes we had massive moves in the bond market. we'll get massive moves in the stock market. And a lot of times they're head fakes. If you are someone who reacts to prices moving, this is probably an afternoon just to sit out. Because every Fed afternoon, just about every one, we have whipsaw action. The first move isn't the real move. And then the second move sometimes isn't the real move. It sometimes takes 3 or 4 or 5 moves before you figure out what the heck the market is, deciding to do into the close. And you can have wild swings. So if we look at the S&P 500, for instance, we're in a range right now. I would say that 4179 level is the high that we want to keep an eye on. To the downside, 4050, that would be the recent low. We're sitting almost in the middle of that, and I feel like in that range, anything goes today. If we were to actually close outside of that range on either side, that might be worth noting. Probably would be worth noting. But anything in that trading range goes today, as far as I'm concerned. And we might see a 50 or 60, 70 point drop on the S&P 500 after the news comes out. And then we might see it back up by 50 later in the afternoon and then back down by 30. I'm not just making up numbers. I mean, I've seen it. If you follow after the Fed announces, those types of moves are certainly very, very, I'm not going to say likely, but they're certainly possible. Going back to that 10-year, excuse me, back to that 10-year Treasury yield for just a minute. I do want to mention the ADP employment report came out this morning, much stronger than expected. So that might be something that weighs on the Fed. I'm sure the Fed has the non-farm payroll number for Friday. But ADP employment report, we were expecting 143,000 jobs, came in at 296,000, more than double. Will that have an impact? I don't know. But we got that policy statement, the FOMC policy statement at 2 o'clock today, 2 o'clock this afternoon. Other than that, the only other thing, April ISM services expected to come out at 10 a.m. this morning. March was 51.2. We're expecting to see that jump to 51.7. All right, back to that S&P. So I went over the key top and bottom. Grab a little water. So those are the numbers that I would at least be keeping an eye on if things get crazy. And again, if you react to these moves, I wish you the best of luck because they can change on a dime in both directions. So just be careful today. NDX. See, now NDX, we actually did get a slight breakout, and we've actually had a false breakout because we've come right back down beneath that double top. Is that a problem? Well, if you'd asked me that probably 10 years ago, I would have said, yeah, I don't like that. I don't like breakouts and then failed breakouts right on the heels of it. But after studying the market for these last 10, 12 years and all the volatility we've gone through different periods, we've seen many, many false breakouts where we come back down, sometimes hitting key support to the downside, or maybe hitting the 20-day moving average, and then simply moving back to the upside. So right now, I'm viewing this, at least for now, as an uptrend with that rising 20-day moving average as support. That would mean that the NASDAQ has about 118 points down to the 20-day moving average. That's what I would be watching on the NASDAQ, 12,995 on the NASDAQ 100. So really, let's just call it 13,000. If we finish today below 13,000, I think in the short term, that is a negative for the market. Doesn't change my long-term view. I remain bullish. It's going to take more than a 20-day loss. We've seen 20-day losses. It happens. Doesn't happen often when you're trending higher, but it does happen, and you can bounce back. So I'm not looking at a loss of 20 days as a significant deterioration in the market, but short term, I respect prices below the 20-day moving average. That could mean test of the recent low, could mean a test of these lows, 50-day test. None of that would be shocking to me. Now, a couple of big red candles big red filled candles that take us below the 50-day with volume really accelerating, that would be something that would bother me. That would start to paint a little bit different picture. It would certainly bring this low on the NDX into play. So if you're asking me, hey, what would really start to get the hair up on the back of your neck? Probably be a few of those big red filled candles. And the reason I want red filled is I want to see selling during the day. I don't want to see these gap downs where you gap down and then rally back, gap down, rally back. To me, that's not selling. That's no one getting out. That's no distribution. So anyway, keep that in mind. Let's move on. So if you like chart of the day, I'm going to show you the one we featured today in the Earnings Beats Digest. But if you want to be part of this and you want to have it emailed to you every Monday, Wednesday, and Friday that the stock market is open, go over to earningsbeats.com and scroll down. Right here in the middle of the page, you'll have an area where you can sign up. Name and email address, all it takes. Hit that subscribe button, no credit card required. You can unsubscribe at any time. Hold on one second. Anyway, it's a great way to follow some of the stuff we do, the things that are important to us. I try to feature on this newsletter. Also, anybody who is an EB Digest subscriber can come to our free events. We reach out to our EB Digest community, and we have many, many, many thousands of subscribers that we reach out to. So if you want to be part of that group and be able to attend a lot of our free events, or well, all of our free events, make sure you sign up there. All right, so today, it's earnings season. I've been talking a lot about earnings gaps and how I like to trade earnings gaps. And if you look at AAN, which is Aaron's company, you can see that we had the big gap up with earnings. Look at the volume come in, big gap up. We went from $10.22, I believe, something like that, up to almost $14 in 4 days. So that was probably about a 38% move in 4 days. The gap up to the upside alone was 20%. So big move up, big volume. And now here we are coming back down on lighter volume right near this gap support level. So the question I kind of posed in this morning's EB Digest article was, what do you do when you have a lot of mixed signals? And when I say mixed signals, there are a number of things I'm talking about here. I mean, we've got the gap up, we got the volume, we got the continued move to the upside. That's all great. We got the pullback on lighter volume. Okay, that's good. But what am I to make of this AD line down near 52-week low? That's not really giving me any signs of major accumulation. So what do you do with it? I mean, that's just one part of it. Let's look down here at relative strength. Look at the group. This is durable household products. It has been on the decline. If you're calling 2023 a bull market, or since the lows in October, the new bull market, which I am, or just simply a resumption of the secular bull market, the end of the cyclical bear, this area of the market has not participated at all. I mean, literally, it was at a new 52-week low in March. The group was. And when we look at Aaron's, and we look at the relative strength, you see with earnings, that jump up, it went to a new 52-week high relative to its durable household peers. So that should be a good thing, right? You got a leader in the space. You got a leader in the space, but you got a leader in one of the worst areas of the market. So how good can you do? Look at AAN relative to the S&P 500. We were down near a 52-week low, and we weren't far from a 52-week low when earnings came out. We got a pop, but look at it. It's rolling back over again. So what do you do with a stock like this? I mean, you're looking at it, you pull it up, maybe it's come up on a scan of yours and you see this and you're like, well, it's a gap support. This is probably a buy. But when you look at most of the other corroborating indicators, they're not really supporting a buy. Well, I can tell you what I do. I ignore it. And if you really felt compelled, you had money you're just, burning a hole in your pocket and you really wanted to trade and you decide you're going to get in, I would keep a fairly tight stop on a stock like this because it just doesn't look that good. When I look at this versus something like Meta or Microsoft, some of the other companies that have come out and reported great numbers and look superb. How about Las Vegas Sands? I mean, they all look so much better to me than Aaron's. But we are at gap support. I mean, I would give the odds probably better than 50-50 that it's going to bounce, but I just don't have a whole lot of confidence because just about every other signal that I like to look for or look at is telling me just stay away. So mixed signals here. And I just want to point out, it's not always a walk in the park with trading. In fact, if you've been doing it for a while and maybe if you've had you've struggled with success, you know what I'm talking about. I do think it takes a lot of experience. I think it takes a lot of perspective. I think it takes a lot of common sense, in addition to being an astute technician. I think you need to be aware of history, seasonality. I think you have to have at least one eye on the fundamentals, which is what we do at Earnings Beats. We try to put all of it together. We have seasonality chart list. We have combination of fundamental and technical chart list. Companies have to be strong fundamentally and technically to be on these chart lists because these things matter when you're trading and in your trading success. Anyway, let's see what AAN does later today and throughout the rest of the week. See if it can rebound. All right. One other thing I wanted to talk about. Market's just about set to open. I'm not going to spend a lot of time on these things, but there are a couple of industry groups that have been really hot in 2023. And I wanted to just point out some of them to you. You're probably aware, but maybe you're not. One has been the internet stocks since January. Huge move up. Year to date, this group's up 31.6%. Been trending higher. When I talk about aggressive areas of the market, and I like to follow aggressive areas of the market, and that those are the most important to me, internet is in that group, and it's in a short list. If you go to discretionary, some areas, gambling is an area that I like to follow. Because if the economy is strong or folks feel pretty good about their money, they're going to show up in casinos. People like to gamble. And so look at the gambling index since that October low last year, and even since beginning of the year, gambling stocks up over 31% and recently broken out. Doesn't look like what you would expect heading into a recession. How about travel and tourism? Strengthening again here this past week, breaking out above all this congestion, sideways consolidation. Seems to be heading for that February high. Home construction. You worried about inflation? Because if inflation's a problem, rates keep going up. 10-year treasury yield should be going up, which would send mortgage rates up, which would mean home building stocks going up would make no sense. But yet here they are breaking out, continuing to break out. Home construction up 28% year to date. Doesn't look much like rates are going to stay high, based on what I'm seeing anyway. How about semiconductors? Always on my radar. Semiconductors been trending up, and year to date up 28%. Just recently put in a nice hammer right at support. I'm expecting it to continue to go higher. That might be challenged a little bit because AMD reported after the bell yesterday, and AMD is down. Last time I looked, it was down like $5, 89 to 84, something like that, but I haven't looked in a while. We'll look at that one in just a minute. How about computer hardware up 28%? This is the home of Apple. Apple reports later this week. I love Apple heading into its earnings. I think they're going to have blowout numbers. Whether that means they go up, or gap down, sometimes that makes no sense. In other words, you can see blowout reports and the stock can still get hammered. Because if it's already been built in, if it was a buy on rumor kind of a thing, sometimes they come out the news and you see the stock sell off. Anyway, this group looks really strong to me. Not far from the August high. Watch that August high. Software's done well, up 21%. Those are some of the key areas. Now, as far as actual earnings, a couple of key earnings, and I'm going to wrap up with these. First, AMD, and the market is open. So, yep, down $6, 7%. So, semi is probably going to need AMD to rebound later today. It did gap down below this support level, which I don't like to see. I would have liked to have seen it hold that on the open. That could lead it. Well, you got gap support here, but probably the biggest gap support all the way down to 75. AMD is a pretty big part of the semis. So if it goes down to 75, wouldn't be overly excited. I do like the AD line though. So even though it's gapping down and it may trade down in the morning, that AD line says probably going to rally this afternoon. And yesterday I mentioned SYK on my show. Remember I said the gap down anywhere from 280, 285, mid 280s looks pretty good. Wouldn't be surprised to see a rebound on SYK. It got down to like 284 and went all the way back up. Look at this intraday move on SYK after it gapped down. So when stocks look good and they gap down, sometimes there are opportunities that you at least need to be aware of. So AMD gets the gap down. So far, trying to come back. It is back up over 84. We'll see if it's able to stage a rally like we saw with SYK yesterday. How about Starbucks? Starbucks reported. And this is a perfect example. By the way, AMD beat on their bottom line, 60 cents versus 56 cents. So they didn't miss with earnings. Starbucks beat 74 cents versus 64. But look at this pre-earnings run. That is almost a perfect pre-earnings run. The 28th of the month prior to the earnings coming out, literally from 97.5 to 115. A lot of buying. Look at the AD line. Then the earnings come out. So it's buy on rumor, sell on news. They came out with good numbers, and then you get the sell-off. It's really hard to determine whether a stock's going to gap up or gap down. I can be pretty good at telling you whether or not they're going to beat estimates, but it's really difficult to say whether or not they're going to gap up or down. Ford reported. Ford gapped down. Now it's up about 2%. We'll see what happens there. Ford had an easy beat, 63 cents versus 40 cents. Simon Property Group, this is one that had been really struggling. Well, at least since the February high. They came out, they did miss 274 versus 280, but the stock's flat today. So this might be a case of sell on rumor. And now that the news is out, maybe the stock buy, maybe it's a buy. All right, last couple companies reported this morning. CVS came out 220 versus 207, easy beat on the bottom line. Stock goes down anyway. This is a stock that's been downtrending for a long time, and it continues with earnings. Now, we'll see if we get some kind of reversal. Maybe we'll get a hammer print, double bottom with a hammer, but we got to wait to see how it trades the rest of the day for that. Another stock I was kind of watching was Verisk Analytics. It's been strengthening. You can see going into earnings. It pulled back right before earnings, but we had a nice push to the upside. They beat 129 versus 118. All right, let's take a look and see what is going on to open up. And we got the NASDAQ up 26, S&P up 6, Dow down 15. So a little bifurcated action. Right now, the NASDAQ leading. If that holds up going into the Fed announcement, I mean, I would expect it to be, if you're bearish, you certainly should be expecting that to flip. You should be thinking growth stocks would be what would be taking a hit in fear of what the Fed might do or say. Right now, that's not the case. Yesterday, that wasn't the case. So I question a lot of folks, I think probably are banking on the Fed to do something or say something that takes this market down. I think it could be the opposite. But, we are at a major critical juncture on the chart. Let's see what happens this afternoon. Anyway, that's it for me. Everybody have a great day. I appreciate you tuning into our stream. Like the video if you're watching the recording. Like the video. Subscribe to our channel. We'd love to have you. Everyone, have a great day. Happy trading.